What I'm going to do today is talk about a case, and the case is Amazon, which I think you'll find interesting. And my motive is that I want to give you a taste for what we do in the financial analysis and accounting executive module here. And the overview of that course is that it's essentially about storytelling. So what I try and do during the week is pretty much cover the waterfront, looking at many, many cases, different balance sheets, different balance sheet types, different business models. But always my goal is to say, how can we tell the economic story of a business from its numbers? So that, you know, there's some technical stuff, and in a minute I'm going to put some numbers up. Brace yourself for that. And we talk about the accounting rules, inevitably, because you need to have an overview, at least, of how GAAP, as it's called, GAAP, works in order to understand when you're being misled. But basically, the core of it is, as I say, very simple. And the reason for choosing Amazon, which is one of the cases we discussed during the week, is that, of course, it's eternally interesting. In that, indeed, in that paper Priya was talking about that I wrote at the time of the dot-com bubble, where I argue that it was just not possible, rationally, to understand the valuations that companies were sitting on there. I used Amazon as the case as the case then, and so it continues. Amazon is now one of the world's most valuable companies, as you know. I think its market capitalization is about $600 billion, something like that. But it's still, 25 years later, not making any money, as far as one can tell. And so there's a mystery here. And in a sense, it's a bad example for what I want to discuss, because of all the companies I've ever analyzed, Amazon is the most impenetrable. It's the one. Jeff Bezos famously is not very interested in investors or talking to investors. He goes to no lengths at all to explain in his financial statements how he's doing it. And so there's always been an enigma at the heart of Amazon, and that's the enigma I want to explore. But first, let's start with the big concepts, and there are two big ideas, I suppose, that lie not just behind financial analysis, financial statement analysis, but corporate finance too. You know, the big idea in corporate finance is this idea of value creation. A company, we need companies to justify their existence in economic terms, to do two things: to earn a return on the capital that investors have given them that's greater than the investor's required return, we call it the cost of capital, and to grow. And so this is the classic strategy consultants 2x2, which captures that. We kind of hope that companies are all going to be up there in that top right-hand corner, earning a decent return, a return better than the cost of capital, and of course growing at the same time. What we know, and I'll tell you about this on another day, from research, and I do quite a bit of research in this area, is that it's getting harder and harder to get to the right of that vertical. The world is so increasingly competitive. There's almost no sector now that's not globalized. IT, the actions of people like Jeff Bezos, I suppose, amongst others, have torn down so many of the competitive barriers that almost every sector we look at is lethally competitive. And even earning your cost of capital, even earning that minimum required return, is something that many companies fail to achieve. So it looks neat to be up there, creating value. That's always the instruction to CEOs. It's harder and harder to do. And then the second big idea, and I'm going to come to this towards the end, is how we put a number on value. You know, what is the value of a company? When we're valuing a company, how do we do it? And what we understand, and it follows from the previous slide, is that a company only has value, ultimately, if it can generate free cash flow. And what is that? Well, the company makes profits, hopefully, let's call those the earnings of the business, but it has to reinvest some of those back into the business to grow the balance sheet, because to operate, you need to maintain, most companies need to maintain a balance sheet, need assets, And if you're going to grow the business, you need to invest in more assets. The pure surplus, therefore, that a company generates is the difference between its earnings and what it had to reinvest. And we call that the free cash flow. And that's our test. So when we're valuing a business, we'll simply forecast its free cash flow to the distant future. And that's our evaluation. And it could be no other way, because, and again, casting my mind back to the dot-com bubble, a lot of my strategy colleagues sort of cornered me up against the wall in those days and saying, Chris, this is no longer holds, this model. It's not, there's a new paradigm out there, you know, in this technological world. There are lots of reasons why companies can be valuable. I don't think so. Because you're only going to invest in a company. You're only going to buy its shares, give it capital. If at some point you're going to get your money back, plus a decent required return on that money. And unless the company has free cash flow, it won't be able to pay you that dividend, or repurchase the shares, or whatever its preferred way of giving you the money back is. And the arithmetic's quite simple, and we'll look at it later, and we'll apply it to Amazon as we struggle to, in my case, but you can, at that point we're going to open it up, and you can explain to me why Amazon's market capitalization is 600 billion. But, you know, I've no reason to doubt that basic principle, the need to, at some point in the future, directly or indirectly, generate enough cash to give back to the investors, to repay their initial investment and a return, must be what it's all about. There is no other model. Right, let's tell Amazon's story. I'm going to go back to the beginning, and I apologize if a page full of numbers, there's a slightly denser page coming in a minute, so grips you with fear, but in fact the intuition is very simple. What I'm going to do is look at Amazon's profit and loss account, its income statement, over the years, and see how it's evolved, to see how the business is making money. And if you wind the clock, let's imagine it's March or so, the year 2000, peak of the dot-com bubble. We just received Amazon's 1999 financial statements. And this, somewhat summarized, is what we saw. So, if you recall, well, I'm sure part of the reason I chose Amazon, I think we all know its backstory. So, Jeff Bezos was a Wall Street banker who, sort of in the mid-90s, thought, I see an opportunity here. So, helpfully, he had a successful leaving party from Wall Street. His colleagues gave him $2 billion of capital to get him going. So he headed off to the West Coast, and working out of his garage initially, and there's always that's always part of your street cred, as you know, many tech companies start life in a garage. So working out of his garage, he built this business, and the rate of growth, I mean, the one thing we can never deny about Amazon is the extraordinary sales growth, right? So in his first full year, he had sales of 16 million. 3 years later, that was 1.6 billion. So that's quite a rapid rate of growth. So he gets a tick for that. But was he making any money? Well, if you cast your eye down, and again, when you join us here, which I hope you will, I'll explain the logic of an income statement, but let's just hope it's reasonably intuitive. Yes, the sales are the value of what the goods and services you sell, but then of course the question is, what are the costs? And we like to divide the costs into two sorts. The costs of manufacture, if you like, or in the case of a retailer, the costs of fulfillment, providing the buying the books and CDs, which I suppose it mainly was back in those early days, and then packing them and posting them and warehousing them, sending them off. We'd call that the cost of sales. And then the other main cost category is your overhead, the costs of the business. And we're going to talk a lot about that because that's key to understanding Jeff Bezos. SG&A. So if you look down the line, you'll see that, well, his gross profit appeared to be okay. He was earning a profit margin of about 18%. So his gross profit was 291. But down, his SG&A, his costs of running the business, were pretty hefty, even then in those early days, about 430 million. So his operating profit was negative. It was minus 383. In other words, his margin was minus 23%. And people commented at the time, this looks like a charity. What this guy's doing is giving books away for $1 that cost him $1.23, effectively, to provide. So it's a charity that takes money from Wall Street, because those nice chums of his on Wall Street had furnished him with $2 billion to fund all this, and gives it to people who like reading books. And I'm sure, you know, that seemed like a good cause. In fact, it was even worse than that, because he had other costs, of which an interesting story lies behind these. What he'd perhaps unwisely done in those early days, but I'm sure I'll put my hand up too, I think he wasn't the only one who spent money unwisely buying .com shares. So even though he was a .com, he spent about $1 billion of the $2 billion his investors had given him buying shares in other .coms. And almost all of them, of course, as some of us know to our cost, turned to dust in his hands. So already the auditors were starting to insist that he write those off. So here, that thing, other costs, was him starting to write off these rather hasty investments he'd made. So in the end, and the number the key number that we like to focus on for this sort of discussion is what we call EBIT, earnings before interest and tax. His EBIT was minus 30, margin was minus 30%, 37%. So pretty melancholy. But of course, that's what .coms look like. You wouldn't have been a .com if you weren't making enormous losses, it seems. And of course, Jeff Bezos, who's famously adventurous when it comes to his accounting, had a brilliant solution. Let's go back to the top. This was an extraordinary bit of accounting he did. The cost of goods, the cost of sales in a business like this, which is essentially a warehousing online retailer, presumably are, well, the cost of the books, and then the cost of picking, packing, posting, fulfillment, we call it, the warehouse cost. He decided to ignore the fulfillment cost. And in fact, he hid them, his fulfillment costs, down below in this category here, hoping nobody would notice. Because it was rather important to claim that at least even though he might be making a loss overall, he had a positive gross profit margin. So his gross profit margin was 18%. Why? Well, because he's growing at such a lick that just the simple logic of break even would lead you to conclude that, yes, if those overhead costs there don't grow much more, he's going to break even pretty soon if he's still earning an 18% margin on every book he sells. Well, conventional accounting would treat the fulfillment costs as part of his cost of sales. And if you did that here, his gross margin actually was a mere 3%. So when's he going to break even? But it's going to take, even at that rapid rate of growth, it would take him years to start turning a profit, it would seem. So this became a famous bit of creative accounting that from Jeff Bezos. That's back in 1999. Well, you might be skeptical, but on his side were two worthy advocates. Salomon Smith Barney, who were his investment bank, as they were then called, and McKinsey, and we know McKinsey. This is the only time I remember McKinsey ever dirtying their hands by engaging in writing an analyst's note. So this was a very hefty bit of analysis, an 80-page broker's note, essentially, that said to the world, and it was published in March 2000. Yes, I know those, essentially what they said was, I know those 1999 numbers don't look too impressive, but we actually think Amazon is the best thing since sliced bread. And they forecast, and it's quite nice. It's rare that analysts are so explicit in their forecast. They said, if you look, we think in 5 years' time, it will look completely different. His sales will have grown to about 14 billion, if you add under the various categories. And on that, he'll now be turning a good profit. So his EBIT, earnings before interest and tax, will be positive 1.75 billion. So just be patient, was what they said. And, you know, how would you react to that if you were an outsider? Well, I suppose you'd think, on the one hand, you'd recognize that the authors are his paid advisors, so maybe they would say that. But on the other hand, you'd also recognize that we don't really know what's going on inside the business, and this has always been a problem with Amazon. And these people at least have the advantage of being insiders. So they are his bankers, they are his strategy consultants. So, you know, maybe there's truth in what they say. So the markets forgave him, and this thing sat on a market capitalization in those days of about 30 billion, even though it was making enormous losses. So this is how it played out over the next few years. So the year I was just talking about was the darkest year with hindsight, 1999. Jeff realized he needed to start making a profit. You can't go on making losses at that level very long, because to make a loss is to consume enormous amounts of cash, and he was running out of cash. In fact, by about 2000, he'd used up the 2 billion of cash, and he needed another fundraising from investors. So what he did quite efficiently was turn the corner in terms of profitability. If you look at the year 2000, 2001, he's holding his overhead costs. Now, let's talk about these overhead costs. What are they? Well, just about any tech business you look at, overwhelmingly, its costs will be marketing, two types of intangible asset building costs, if you like, the cost of building your consumer base, building your brand, and the technology cost, the cost of building a platform. And for Amazon, those two categories have always been overwhelmingly what he spends his money on. And we're going to track those through time. So what he did, in the spirit of this break-even ambition, was to hold those costs down for a few years. He recognized, I've got to keep on growing and start generating some gross profit. And then, if I hold my costs, my sort of overhead costs down, I'll start to turn a profit. I'll start to break even. And that happened in 2000, almost in 2001, certainly by 2002. He was making a profit. So he's a dot-com who's survived and is now making a profit. He never quite achieved the sales or the EBIT, earnings before interest and tax, that his mates McKinsey and Salomon Smith Barney had predicted, but never mind. You know, this was an impressive performance. He became firmly profitable at a certain level. How did he do it? Well, he actually managed to get his gross profit margin up to about 15%, which is really where it's been ever since. And by keeping the foot on the brake with spending on marketing and technology, he broke even. And if you were the shareholder, you'd be interested in the bottom line, which is literally and metaphorically the bottom line, which is earnings, which is profit after interest and tax, or if we were in the US, we'd call it net income. And that had been enormously negative for the first 10 years of his existence. But he starts to deliver some positive earnings to investors. So far, so good. Then what happened? Well, what happened next, of course, reminds us that Jeff Bezos is, by nature, I think, eternally put on earth to frustrate investors and to keep them guessing. Things seem to be going really well. His sales growth, so taking the next decade up to now, so the last year of financial results we have is December 2016, the final column. Sales growth remains spectacular. I mean, there are few companies in history that have sustained a 20 or 30% per annum rate of sales growth over a 20, 25-year period. So again, we can never take that away from him. But what about profits? What's happening to profitability? Well, bizarrely, his operating profit simply plateaus. And as a margin of these burgeoning sales goes down and down and down. So his profit margin, even though he's now global, firmly established, the market leader, it would seem, in his just about all the categories he works in, which you would normally expect to convert to fat profit margins, his profit margin declines. Either his operating profit margin or his EBIT profit margin. And if you were a shareholder, well, a patient shareholder investing in this business, you might have been alarmed to find that his earnings, having been, well, never much more than $1 billion at the very best, are now negative again. So 20 years in to this business, around here, 2012, 13, 14, he's making a loss for him, shareholders, negative earnings. Okay, the last 2 years were a bit better. We'll come back to those in a minute. So, well, in a minute, I will discuss, and I want you to tell me what's actually going on here. Why is the company we view as one of the world's most successful businesses, and it's now one of the world's most valuable businesses, so unprofitable? So let me click forward to the issue of valuation. Here's the slide I showed earlier. What does this actually mean? How do you value a business like this? I think, we believe, here there's only one way to value any business, and that's in terms of the free cash flow that it will generate. And we will allow, if you like, the hockey stick, the J curve that is characteristic of technology businesses. We'll allow these businesses to make big losses in the early years. That's in the nature of the game, because you're investing, typically throwing billions of cash at building various intangibles, your brand, your IT platform, your technology. But eventually, you know, it has to be a hockey stick. Eventually, there's got to be some cash flow. Otherwise, what would be the point? So what's the arithmetic of that? If we assume that the market value of any business is simply the value of the projected free cash flow that the company is going to earn, exactly how much would you need? Well, here's some back-of-the-envelope valuation arithmetic. If a company has a market capitalization of 100 billion, and investors want a 7% return, which is probably a reasonable guess as to what equity investors in economies such as the US or the UK are asking for at the moment, the required return of equity investors, then they'll only get that if that asset, that business, delivers 7 billion a year of cash forever. I mean, the arithmetic of that is easy to see. If I've got $100 and it's going to give me a 7% return, it's going to have to give me $7 a year of return. Or, if it's going to be a short life business rather than a business that lives forever, correspondingly more. So, over a 10-year horizon, 100 billion of current valuation that you're putting on that business now must require 14 billion a year of free cash flow. Or if it's got an even shorter horizon, if you're skeptic, if you think tech businesses really live in such an uncertain and fragile world that really they'll need to deliver the cash flow to me in the next 5 years because they might not exist after that, then even more, you know, and you could go on playing with the numbers. So that's the sort of measure of cash flow you would need. And if the company's still in growth, if it's still in the underwater part of its hockey stick existence, then, and if the payoffs are going to be in the future, then correspondingly more, obviously, is what you're going to need to make up for the discounting and to make up for the time value of money, that is, and to make up for the uncertainty. So what would you have got? So how does that look in Amazon's case? So Amazon's market cap currently is actually $550 billion, or it was last night when I tweaked this slide. 25 years into this company's existence, for the first 10 or 15 years, its market cap was resolutely 30 billion, even when it was making losses. So investors trusted it and they thought, okay, let's put a valuation of 30 billion on that. Even 7 years ago, it was just 50 billion, but it's, I'm sure you've noticed, it's skyrocketed in the last year or three. Well, applying that arithmetic from earlier, we'd need, instead of bringing these ideas together, if we're going to attribute 100 billion of valuation to a company, and if we thought it was going to live forever, we'd need that 7 billion a year of cash flow delivering to us. What is the cash flow at Amazon? Well, free cash flow is quite easy to calculate for businesses like this because, again, let's go back a couple of slides to that. What is cash flow? The cash you can, the pure surplus of cash, which is what free cash flow is simply the earnings of the business less what you need to reinvest to build the balance sheet. And it's a useful fact about these companies that these tech businesses, they typically don't have a balance sheet. So Amazon has very few assets in its balance sheet. So that makes the arithmetic particularly simple. Earnings is free cash flow is approximately earnings for a company like Amazon. So what have Amazon's earnings been? Well, as you saw on that earlier slide, over the last 5 years, it's been pretty miserable. Negative, 274 minus 241, blah, blah, blah. Add them up. In total, over the last 5 years, Amazon has earned 3 billion. And of course, he doesn't do dividends, so investors are not getting their hands on that 3 billion yet. And in fact, in the whole 23 years of its existence, I just, in an idle moment yesterday, calculated, Amazon's earnings in total have been 7 billion. Well, again, I don't want to be too doctrinaire about this, but that's quite hard to square with a market capitalization of 550 billion. There's going to have to be some extraordinary hockey stick uptick sometime soon. Compare and contrast Apple, was another interesting subject of study. Yeah, Apple, of course, is the world's most valuable company thus far. Its market capitalization is now 900 billion. But, you know, this is strikingly different to Amazon because Apple is a cash machine. And every year for the last 5 years, Apple's earnings have been about 45 billion a year, somewhere between 45 and 50 billion a year. And moreover, Apple has religiously paid every dollar of that out as dividend to its investors. So about 5 years ago, Apple was piling cash up, as you know. It built a cash pile of about 250 billion. And activist investors, I think Mr. Carl Icahn was the leader of this particular pack, put an arm lock on Apple and said, you know, even you, Apple, can't carry on doing this. This is ridiculous. You've got to start paying it out. And they agreed. So in the last 5 years, Apple has paid every dollar of earnings to its investors, either as dividend or by repurchasing shares, which is the same thing. So yes, that's an extraordinarily high market cap. My nice basic valuation arithmetic on the previous slide, or a couple of slides earlier, would struggle perhaps to really square those two numbers, but they're much closer. It's much easier to see why 900 billion might be a reasonable valuation for a company that's ladling out free cash flow of about 50 billion a year to its investors. But Amazon is the real enigma, because it's just 20, 25 years in this company. It's not really reliably making any earnings at all. And in this industry, earnings equals free cash flow, pretty much. Nonetheless, we're valuing it. The lick at which its market cap is increasing at the moment, and it's going to catch up with Apple fairly soon. And again, idly Googling yesterday, I noticed that some analyst is saying, oh, it's only a matter of time between the market cap, before the market capitalization of Amazon is 1.6 trillion. That was this analyst's evaluation. So what might be going on here? Let's go back. Let's do some financial analysis. There is a complication, and it's to do with how accounting works. This nice basic logic of finance says you have your earnings, your profit after tax, and then you have to reinvest to grow your business. But it's a feature of tech businesses in any tech sector that almost all the reinvestment, almost all the investment takes place in the income statement rather than the balance sheet. And this is to do with the way accounting rules, GAAP, work. Because very conservatively, the accounting rules say that if you invest in intangible assets, brand, R&D, IT, stuff like this, because we don't really believe they're assets, this is the accounting regulators, we're going to force you to expense them, charge them to your income statement every year. And that's potentially confusing. So the optimistic story about Amazon is that he's not actually unprofitable at all. It's just a confection of how the accounting rules work. And you can see it up here. See, these are the two lines you'd want to focus on if that was your story. And every year, as he's grown and become more and more dominant in the world, what he's done apparently is simply reinvested every dollar of the surplus back in marketing and particularly back into IT. So he says to his people, look, view the profit of the year as a fund that you can reinvest. And if it was an old-fashioned metal-bashing business, a manufacturer, that reinvestment would be on the balance sheet and the profit would be the reported profit. But because it's a tech business, the reinvestment is in intangible assets and it shows up as an expense. And so his bottom line is kind of zero, more or less, not much more than zero, which would be consistent with the positive story, which is that Bezos very skillfully has built a relationship with Wall Street such that he's telling them to go away. He doesn't care. He's not going to give them earnings, which is their normal expectation. He's simply going to reinvest it all. But again, well, suppose that is the story. And there now, I'm out of my comfort zone because I simply don't know enough about technology expenditure and how much of that expenditure is maintenance expenditure, if you like, needed to keep the business in its current size and shape. How much of it is actually growth capex, as investors would call it? How much of it is growth expenditure? I don't know, but I mean, if you thought half of it was growth, then you'd be saying that about maybe 12 billion is hidden profit, hidden earnings, but that would be before tax. You'd have to take tax off, so I don't know, 8 billion after tax would have been reported as earnings in a conventional company who invests in it through its balance sheet rather than through its income statement. So in that case, his underlying earnings might be 10. You might argue that they were 10 billion rather than 2 billion, 2.3 billion. You'd have that bit of line of conjecture, I think, you'd need to pursue. That's the optimistic story. 10 billion with a year of earnings, does that justify a market capitalization of 550? It's pushing it, but that would be that's the story you'd have to tell. If you were to attribute this extraordinary gulf, and Amazon is the most extreme case of this I've encountered, between the value that investors are putting on the business and the financial performance as reported. But there is a more melancholy story, I think, which is that actually he may be just not a very profitable business. That Jeff Bezos is a great entrepreneur, he's a great innovator. He's inventing it. Maybe we can give him some credit for pioneering e-tailing, e-retailing. He's now taken the cloud computing world by storm, as you know. He's the leader in that world. But these worlds he creates are intensely competitive. There are not really many barriers to entry. And people are not making money in those worlds. And if that's the story, then that might be a fair account of his profitability. And if that's the story, that does make his market capitalization particularly hard to understand. I'd quite like in a minute you to tell me, as I say, I understand the numbers, but I know nothing about technology. But you probably can answer this question. Which of these two stories do you think are correct? But before I do that, just let me tell you something about his financial reporting. Companies are supposed, required actually, but it's not enforced, unfortunately, by auditors, to give you some rich segment data to help you understand the underlying economics. So here you've got a business that's now got sales of 150 billion heading for that. So he's doing lots of different things. So what the accounting rules require is that a company should disclose a profit number, a sales number, and an asset number for all the segments that the CEO, Mr. Bezos in this case, regularly monitors. In other words, give us the granularity of data that the board, the board of directors themselves would require monitoring the company. Companies just don't do this. I think I constantly campaign about this. It's one of the biggest failures in accounting. Auditors are not enforcing that. And Jeff, of course, famously indifferent to accounting standards, never did any. He didn't give you any disclosure at all about segment performance. And last year in 2016, he started. But it's not much detail, but it's better than nothing. So what he told us last year was the sales by segment and the income by segment, and therefore I calculated the margin, which is the operating income divided by the sales, for his segments. What segments did he disclose? Well, the two old existing businesses, retail, North America and the rest of the world. So that's what those two top lines are. And his cloud computing business, AWS, which is Amazon Web Services, which is the exciting bit. That's the bit he's interested in now. That's his new project. And it's quite interesting. Stunning, actually. So, going back to my conjecture of a minute ago, it would appear that in the retail business, which is still overwhelmingly the source of his sales, revenue, he's making just about no money at all. It's clearly, presumably, it's just a highly competitive space. So, of his 135 billion of sales last year, well, 120 billion or so come from the retail business. And the profit margin on his retail business is, well, 3%, is about zero. Because he's making a 3% margin, which is pretty thin on the North American traditional Amazon business. And he's making a 2.9% loss on the rest of the world. All of his profits now are coming from the cloud computing business, which is a relatively small proportion of his sales, but the entire source of his profit. So, if we were doing this under battle conditions rather than just spending 45 minutes on it this morning, we'd have to really sit down and think hard about what story we could tell. If we're trying to value this business, what story we could tell about the future profitability of the retail business, which is overwhelmingly still his main business, and the future profitability of cloud computing. Naturally, well, I tend to be a bit skeptical about these things, but cloud computing, which he dominates, is another nightmarishly competitive space. I mean, there are a lot of deep-pocketed, big tech businesses betting the farm on cloud computing. He's doing well at the moment. That's his main source of income. But is that going to, in such a competitive segment as cloud computing, is that going to generate the free cash flow that you would need to justify a 550 billion market cap? You tell me. What's your view? In fact, let's go back to this. What is financial analysis? Well, we take the reported numbers, we sort of organize them in a sort of simple, clear way to reveal the economics, and then we try and understand that economics. That's what we're doing here. And Amazon is probably the hardest business I've encountered to explain, because he discloses so little, and because there is this central mystery here. Is that reinvesting the spoils of a very profitable business, or is that simply telling us that this is not a very profitable business, that to stay in the game as Amazon, he's having to spend more and more? I welcome your view.
Actually, I've got two. One is a question about taxation, and isn't the assumption that the asset-driven or kind of old businesses, normal, usual businesses that invest into tangible assets, they would be taxed at higher rate because these are investments. However, Amazon that invests into technology, if we say this is just the same similar type of asset investment, they will have tax advantage, as this would be taxed at much lower rate, expense.
That is correct.
Okay.
So the good news, yes, just to embellish the point you're making, boring old GAAP accounting rules force you to expense all these costs of brand, IT, R&D, and so forth. But the good news is that they are fully tax deductible in the year. And if you're, to the extent you're incurring them in the world's highest tax economy, which is the US, then that means that that's quite tax efficient way of investing.
But I have a more complex question also, is this 12-month deadline that every executive faces, especially shareholder-driven executives, to deliver free cash flow or earnings. It certainly creates the short-termism in thinking that Jeff Bezos has kind of escaped. How would other businesses be able to do longer-term decisions and just say to shareholders, I don't care about the earnings?
Well, yeah, you're making an excellent point. And it's quite close to my heart, actually, because there's a big debate, as I'm sure you know, about the future of capitalism. Is capitalism in crisis, so on and so forth. And I'm sort of taking part in this discussion group with some CEOs from here and there, some of the leading industrialists, worrying about this. And we had a fine meal on Monday evening when we're talking about short-termism, the pressures of the short-termist pressures from investors. Well, it's even worse in the US because it's the quarterly reporting pressure for US listed companies. At least in the UK, we don't have that. How can we cure this? Oh, we all worry a lot. I've advised the government on this as well in the past. We're all very concerned about that. But Amazon, Jeff Bezos, of course, famously freed himself from that yoke from the outset. He simply said to investors, I'm not interested. I'm going to run this business my way. I may make earnings, I may not. It's up to you whether you invest in my company. I'm not even going to engage. Good for him. But of course, the problem is, he might, of course, be the perfect example of what happens if you don't have that rigorous investor pressure. Because this is now 25 years. Are we still in the short-term world? When does the long term start?
Never. Actually, never. In a business like Amazon, it shouldn't ever stop.
But yeah, and that's fine. If your mission is to change the world, which I think and that probably is the most appealing mission for the modern corporation. But what should the market cap of such a company be? Because that company is never possibly going to deliver free cash flow. So why would I pay 550 billion for its shares? That's the hard question.
Would it be a problem that the shareholders, the current investors, would start be afraid that there will never be a liquidity event? Because that would be one way to cash.
Well, if they're rational, and they are mostly coldly rational, these investors, if there's never going to be a liquidity event, the share price will slide down the other side of this hill, back to 30 billion or whatever its modest beginnings were.
Well, if you could come back to the other slide where you have the breakdown of the retail and the AWS sales. So you're telling that. So in terms of the retail business, the 115 billion between North America and international, you don't have a margin. And so basically today the business of Amazon is based on the AWS 12 billion business.
That's
and
the number.
If you think that with the competitors that you have in retail today, that the margins will not improve, even the sales would improve, what would be your guess for the right market cap for Amazon? Knowing that that today they have a business of 12 billion, and it's not reasonable to have a market cap of.
Luckily, of course. Luckily, we haven't got time to do that question justice. But you can tell how I would set about answering the question. I'd get my spreadsheet out. I'd say, what could possibly happen to this cloud business? And I suppose the complication is, and this is ultimately the unknown and the salvation for these challenging market values we're seeing in the market at the moment, is that there's a missing ingredient which you might call the strategic options of the business. So, I mean, Jeff is famously, because this is his personal drive, he's not particularly interested. I mean, I'm sure he mildly enjoys being the world's second or third richest person, which he is at the moment because of this market cap. But he would tell you his drive has nothing to do with money, it's to do with changing the world, innovation, and so forth. And he's a serial innovator. I mean, it's a bit of a hop. There clearly was a connection between his first business and his second, because the reason he's done so well in cloud is that the IT infrastructure he built to support his e-retailing was natural, gave him a sort of first mover advantage there. And he's going on to do other things. So how can we quantify those? I can start to build a little model around the numbers I've got, so I could build a nice, neat spreadsheet that projected different rates of growth for his cloud business, developing that number there into the future. What might be the operating profit from this thing under various assumptions. But we just don't know how to value these strategic options, the things he might do in the future that he hasn't even thought of yet.
So you're saying that the company today is completely missed value?
Yeah, of course. I'm going to be like a politician here. So I'm going to say, avoid answering that. I've set up the arithmetic. I think the logic is clear. And but it would be a foolish person. I mean, I got away with it 15 years ago when I wrote this paper, just about at the top of the dot-com bubble. I'm not going to risk my luck again with that one.
Just thinking there, he's mentioned about the low barriers to entry, but he has always shown from the consumer side that he likes subscriber services, things that lock you into the Amazon brand. So he has tried to use as much as he can in his industry to do that. And isn't the best barrier to entry that he's created, in fact, these low profits that he reports? Because Apple were printing, were showing huge profitability, and then one day Google board and Samsung board signed off that they were going to enter into the market, and look where they are now. They've really stop the growth in that industry. So if his motivation is empire building and creating as strong barriers to entry as possible, the best one is these results that he reports each year.
I agree. And you can, so if you compare and contrast him and Apple, Apple throwing off phenomenal amounts of cash. This is overwhelming the cash from the iPhone. I mean, 75% of, I think the iPad is essentially a big iPhone. So if you include those two revenue streams together, that's 75% of Apple's revenues. And that's why they've decided to simply pay it all out. This is never going to be repeated. It's the world's most successful ever consumer product, the iPhone. But that suggests, and we're already seeing it in the numbers, that they won't be growing in the future. They've started. Their sales are shrinking. I mean, Apple's sales are lower this year than they were 2 years ago. It's the one-off of history. So we could project that. The boss is telling me it's time. 5 minutes, I think it's. This is a much more challenging one to project because, yeah, saying I'm not going to make any profit is a great barrier to entry. You're going to kill your competition. But it's not a great rationale for a 550 billion market cap. Is the problem. He can survive. That's a survivable model, and that may be perhaps what he has in mind. He's going to carry on innovating, changing the world. He'll probably get into space travel, whatever his next project is. Fine. It's his business, and he can do what he likes, really. But the interesting question is how that translates into financial performance. And there's really only one game in town there. Unless it's going to be free cash flow, unless you're going to, as Apple have been doing, return some big avalanche of cash to investors at some point, it's not worth anything from an investor perspective. Maybe it's worth a lot from a social perspective, in terms of the health of our economy, from an innovative perspective, but through the narrow lens of shareholders who are paying 550 billion for that. There's got to be some cash.
The other thing, I guess, that is not valued in in terms of accounting terms is the database that you build, which is very valuable.
Yeah. And
also in terms of the cloud computing space, it seems it's very obvious that that's the area that he should be investing in. And if he has all of this very, valuable database of people who are very engaged, they could be supplied with, high quality content.
And I've been saying that about Amazon for about 15 years. But the question is, when's he going to start monetizing it? These are, conceptually, these are very valuable assets he's built. But when's he going to start monetizing them? It's now 25 years.
And also from what you mentioned earlier on, when he used the traditional approach of keeping his overhead costs down, that is something I think he needs to focus on to be more efficient in terms of the innovation.
And we will see. I agree with everything you're saying there. And I think Amazon is a fascinating study. I literally can't wait to get the annual report, because how this mysterious game is going to play out is one of the most intriguing questions we have, corporate questions we have these days. It's fascinating and continuously puzzling, I find. So in that sense, I suppose Amazon's not the best example to advertise the fruits of financial analysis, because it is actually the most impenetrable set of financial statements. But I hope, at least in this last hour or so, I've sort of laid out the landscape, laid out the approach that we always take. And it's if you organize the numbers in that way and tell the story over a reasonably long horizon, you get an enormous amount of insight. And I think, in the case of Amazon, that insight would just give us a list of questions. So we know what to write on our A4 pad when we're going to go and meet Jeff Bezos. Whether he'll answer them, of course, is an open question. I think it's, before you put up your time card,
You're ahead of time.
I know, 1 minute ahead of time.
Any final questions?
Okay.
Well, if there is time. On the slide with the financials of when we were speaking about whether or not the marketing costs, technology costs were maintenance capex or investment capex. would there be any sense in seeing if they're growing at the same rate as sales and what the link is between the growth rate of the marketing?
It wouldn't help you, see, because you'd you're never going to get this level of detail from Bezos. You know, you'd need some insight. I think the more profitable he becomes, theory A, the more, proportionately more he spends on brand and technology. So in that sense, you'd see them going up. Whereas in an old-fashioned capital-intensive world, you'd expect economies of scale, so which is what you're suggesting. The proportion of expenditure needed per dollar of sales will decline if there are economies of scale. But we don't have we just can't make that split. We just don't have the data. He presumably knows the answer, but nobody else does.
Thank you
very much.
Chris.